Hello, listeners, and welcome to another episode of Cognitive Dissidents. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Joining me on the podcast is Rachel Ziemba. She is the founder of Ziemba Insights, and she's also an adjunct senior fellow at the Center for a New American Security. We recorded this Tuesday, November 21st, so the couple days before Thanksgiving. I'm actually literally on my way to go pick up our family Thanksgiving turkey here after I record this intro, but you will be listening to this on Monday. Hope you had a good holiday and hope you enjoy these really excellent insights on Argentina, on Venezuela, and especially on oil and what oil prices might do in 2024 and beyond. As always, if you want to talk to me about our research and consulting services or about our wealth management services, you can email me at jacob@cognitive.investments. Otherwise, hug the people you love. Cheers and see you out there. Rachel, thanks so much for coming on the podcast. I've already warned Rachel listeners, and probably my editor will delete this anyway, but somebody's here to repair the smoke alarm in my home office here. So if at some point alarm bells go off, it's not me expressing something about what Rachel's saying. It's literally just that started happening. Rachel, it's really nice to see you. Thanks for making the time.
My pleasure. Thanks for having me.
We've already done some content on Argentina, but we're talking about emerging markets and energy in general. So it seems silly not to at least start off with got any thoughts about the insanity in Argentina?
Yeah, I mean, look, I think it really sort of reflects that a lot of the electorate is completely unhappy about what's gone before and is willing to kind of, accept some kind of promises, including things like dollarization plans that, it's always been amazing to me how quickly some of the economic cycles can move in Argentina. And I say this as someone, Argentina was one of the cases of my master's thesis almost 20 years ago. So I sort of cut my teeth on watching the political implications of currency choices and the like. And if anything, right, and we've seen several defaults since then. We have seen, sort of different waves. I fear that what the electorate has done is sort of gone for what seems like a quick fix, and a lot of promises. Milei is obviously going to have a lot of troubles implementing those, in part because the legislature doesn't have a lot of his political counterparties. But I think, if anything, one of the challenges that's going to come up is this element of sort of the debts not only to U.S.-based investors, the debts to China. The Chinese swap line has been really important for Argentina. And, and I think real questions about how Argentina is going to kind of try to continue to develop not only the Vaca Muerta, the sort of natural gas reserves that likely would improve what's a pretty vulnerable external balance, but also its sizable lithium reserves, right? I think we're in a world where a lot of countries are trying to think about how do they leverage their critical mineral supply chains. The U.S. has not really articulated very well how to partner with developed economies with those resources. I mean, I think, Indonesia is probably, and some other countries in the region are probably more clear partners. But I think there's a lot of kind of, questions ahead. But I think these kind of the quick fix of some idea about dollarization is, is not really going to work. And so I guess I'm going to be watching for how does China try to leverage their existing, relationship, and also how does Milei interact with it's Argentina's neighbors, particularly Brazil. This is, Brazil is the largest trading partner still, or close with China. We've seen, there's sort of elements of competition there. So, it's striking to me that it only takes 25 years to go from leaving something like dollarization to thinking about doing it again. And maybe it's a nature of the sort of generational struggle and how bad things have been since then. But this is going to be a lot of volatility ahead, and I'd be cautious about any kind of major sort of relief rallies or anything like that.
Yeah, obviously, 100 Years of Solitude was written by a Colombian, not by an Argentine, but I keep on thinking about the repetition of history, exactly as you said. But you mentioned...
And I have a book for you and your readers to read when it comes out next year. My friend Greg Makoff has a book coming out called Default, and it's all about the sort of some of the default cases, and it's a courtroom drama. So any event, might be a future podcast guest.
Okay, well, cool. That sounds great. I'm always in the market for those. You already mentioned Indonesia, and I thought that might be a good place to pivot to actually right now, because everybody was obsessed with the Xi Jinping, Joe Biden meeting last week, and rightfully so. It was big news. We addressed it here on the podcast as well. But for me, the more surprising thing was, Jokowi and Biden also having their own meeting, and the United States talking about wanting to have access to Indonesian minerals, and even in some of the reporting rumors of a very limited free trade agreement. I was like, what decade am I in? Are we back to that story? That's super interesting. So why don't you talk a little bit about I'll take that any direction you want, if you want to talk about Indonesia or critical mineral supply chains or both, but I thought that was a really important development.
Yeah. And Indonesia's been a country I've really been watching both as a potential model for what U.S. friendshoring or not nearshoring. It's still a long way to Indonesia. But sort of shifts and supply chains away from China, how far that goes, and to what extent is the U.S. thinking about the right partners as it's trying to move away from, a critical mineral supply chain that is dominated by China. Now, China really dominates the processing part of critical mineral supply chains. They produce some minerals directly, but it's really about processing. And so that sort of middle part and sort of getting the high quality components, and it puts them in a position where, right now, within the last few months, China has established licensing regimes for a couple of critical minerals, germanium and gallium, that are sort of important components in some semiconductors. They've launched one that's set to come out in early December on certain types of graphite. These minerals aren't all necessarily over the long term dominated by China, but they definitely dominate the processing now. So that interesting question mark on Indonesia of both how does the U.S. grapple with potential partnership with a country where China has been the dominant foreign investor, at least over the last few years. There is U.S. investment in the sector, of course, but new capital has generally come from China. And sort of, is there a way to allow, both countries to sort of, coexist, and what the U.S. goal is? The other thing is that Indonesia encapsulates a trend I think we're seeing elsewhere in the emerging and frontier markets, those that have these resources, which is the desire for both more, to move up the value chain, right, in those sort of critical mineral supply chains and the like. In some ways, it's the exact type of thing that economists like me have been talking about for years, which is, add value, don't just do primary exports, do secondary other processing. So it's a little bit perhaps disconcerting when the natural response when a country like Indonesia or Chile or elsewhere wants to change the rules a little bit and deepen supply chains, or maybe have new rules about water use, that we quickly talk about export protectionism or sort of resource nationalism. But I guess this is all to say that some of it, from my perspective, is just as some protectionism is for valid reasons of protecting, economic goals, that also sometimes resource nationalism, if it ends in a place of providing clear guidance to domestic and foreign investors, not necessarily a bad thing. Predictability is important. So, anyway, get off my little soapbox there. But I think but you're right, that bilateral meeting was important. there wasn't perhaps as much as we might have hoped for on the critical mineral side. What I did notice, I noticed two things in the statement. One was around semiconductors. There's talk about co-developing plants and fabs. We'll see how much real money is behind that. That's similar to some language I think we saw the U.S. put in a statement with Vietnam earlier in the year. The other one is, around this other initiative, the just economic transition, decarbonization. And I noticed this sort of sizable projects folded in here, really between ExxonMobil and Pertamina, the Indonesian national energy company, and around carbon capture and storage, around decarbonization. Indonesia is one of many countries that sort of needs more domestic power source. And it's one, because it has coal, that it's been really hard to decarbonize that power sector. So I thought some of those things were interesting to watch. What I took away, in a sense, from APEC was it kind of reinforced my view that, if anything, the U.S. is going farther with individual bilateral deals than it is with any kind of regional group. One of the disappointments I think people came away from APEC with was this nothing really happening on the Indo-Pacific economic framework. Now, I wasn't expecting much. I think I was expecting some sort of a, pretty loose sort of supply chain related measure, and maybe they decided better to do nothing than to sort of not move things forward much. But I think it just highlights that, if anything, trade policy pillar is not really defined. And I think that's something that is a bit bipartisan. People often ask me, if there's a change in the executive, will we see more meaningful kind of trade policy? We'll see. There's a lot of open questions there. But I do think the U.S., if anything, globally on trade is focused on standards. And also, if anything, there's more of a focus on bringing back supply chains at home, even if that costs more. Now, net result and the hard truth we're going to have to grapple with is that it can't all be done sort of in the U.S. There are sort of labor and input, limitations. And the net result, I think, has been that intermediary countries, or what I think it was Bloomberg called connector countries, are sort of in a position to take advantage of tariffs and restrictions. And Indonesia is probably one of those countries. So, interesting to see that moving forward. Maybe not as much detail as we'd like to see.
Yeah, I mean, you said you weren't expecting much. I'm the guy who was expecting Biden to come in with, maybe try and resurrect the TPP or something like that, and that certainly got blown up.
I wish.
Well, I think he could have, right? I think there was some.
I think he could have,
but he didn't want to. And I don't know how to square this. I mean, listeners are probably tired of listening to me talk about how the left hand doesn't know what the right hand is doing. But it's like the United States wants free and open Indo-Pacific, but also make everything great in America again. And it doesn't seem to realize that you can't do both of these things at the same time.
Yeah, exactly. And look, I think they're perhaps rightly sort of taking or trying to take a bit of a bow. I don't think people are sort of seeing it, but on things like the manufacturing activity in the U.S. being stronger than you'd expect in this point in the cycle, that, I think open question how much that is just a story of things like real estate and construction on things like end-stage battery plants, which, if you really want to make sure that Chinese inputs don't go into those batteries, there's an inconsistency in that policy. It's as you say, a right-hand, left-hand problem. But I do think the trade pillar and what that really looks like is missing in action. And I don't, I wish that were sort of, different. And I take the administration's point that, we didn't do a good job in compensating losers, and we didn't do a good job and that some of the trade policies were more beneficial for American capital in certain segments than others, but there are ways without kind of only sort of incentivizing domestic production to kind of address those issues. You can swing too far to one side. And I think what's interesting, of course, is that on the other side of the aisle, there are a few people sort of standing up for kind of free trade, but not very many. And so I think that element of, it's disappointing not to see kind of more details on the ground for what was a buzzword of friendshoring.
Yeah. Sort of moving further afield, and Indonesia in some ways is a great example to me because one of Indonesia's greatest resources is nickel, but there are other nickel resources in the Western Hemisphere. Cuba has one of the greatest nickel reserves ever, and why the United States can't figure out why its foreign policy on Cuba has not worked, and it's continuing to sort of beat a dead horse. But that's a different topic. I wanted to go and shine the spotlight on Venezuela, where we actually have seen an attempt, I think, to change U.S. foreign policy there. The Biden administration seems like it really is trying to offer the carrot rather than the stick. I'll let you talk about maybe some of those sanctions that they took off of Venezuela's oil and gas sector on a very short term. It doesn't seem like the Venezuelan government has followed through on its commitments. It's already delegitimized the results of the opposition primary, and their candidate, they're saying they can't run. But everybody's excited about, maybe the United States is finally thinking about dealing with Venezuela. Do you have any optimism that A, that's happening, and B, it might portend, the United States thinking a little bit more deeply about its relationship with its actual neighbors rather than farther afield in Eurasia?
Yeah. So, I think in a sense, and it took quite a while in this administration to kind of realize that policy on Venezuela was not working. And I think over time, the externalities beyond anything energy related, but around this sort of way in which, sanctions exacerbated a humanitarian crisis that really, was, predated, but, the sort of flow of Venezuelan migrants. And so I think if anything, you had a shift in foreign policy, but partly, and this view of, well, there is this leverage moment ahead of the Venezuelan election next year. So this time, and, we've seen, a little bit of movement here and there over the last year, but you're right, these sort of sanction suspensions that were announced a couple weeks ago, which I think were a little more front-loaded than I'd been expecting. I spent a lot of my time kind of tracking sanctions policy and the like. I kind of fell into it some years back on Iran and then on Russia, and it's become sort of a kind of, for someone like me who is very interested in how governments try to shape markets. This is obviously a major tool, but I digress. I think, clearly what the U.S. government was trying to do was to to show the Maduro government that there was some benefit into allowing a slightly more fair election. But I was surprised that it wasn't more sort of phased in, I guess because I was skeptical that Maduro would actually allow anything we would define as fair, which leads me to think that the U.S. might be a little more flexible than some of the red lines that they've indicated. That maybe they might give the Venezuelan government a little more time to present at least some opposition candidate. That's, we'll see. There's an end of the month deadline to decide if, what that electoral framework looks like. In terms of the and the other piece, of course, was not only this policy that didn't work and, if anything, had exacerbated humanitarian challenges, but also, I think, a recognition that you can't restrict several different sizable contributors to a major commodity to the global market at the same time.
Yeah.
Right. And I've overhedged that. My apologies. But, that element of, Iranian production until this year was sort of, offline. We can talk about that and the like. Russia, if anything, we have this sort of creative policy that I think worked for a time and, and then kind of has failed at least one of its goals, which is the price cap, kind of letting oil flow, but paying a discount for it, and the like. But I think what's also something that we've seen, or a challenge, maybe not quite as palpably, of, as sanctions on Russia and Belarus tightened, what the impact on global fertilizer market was. Now that there was more ability to kind of make alternate choices, or people use less, farmers around the world, but it was a contributing factor to food prices. So on the Venezuelan side, I guess a couple of thoughts from a market perspective. One is that I think whenever you have a suspension and not an outright lifting, it leads to some businesses. I mean, these are not short-term projects, and so if you're a board greenlighting a medium-term project, you might not be willing to go in with a 6-month suspension, especially when it seems like Venezuela is not, the Maduro government might not actually be involved. So I think it does privilege probably the players that are already there, or those that have claims. The other thing from a market perspective, of course, is that you have whole networks of debt, right? You have the publicly traded debt, sort of these sort of sovereign and PDVSA debt. You have a planned auction of Citgo, Venezuela's subsidiary in the U.S., and a whole list of people waiting to, sort of get their piece of it. And you also have, a lot of other companies in arrears. And I haven't even talked about the arrears to China and Russia. So somebody asked me earlier, did I think $150 billion in debt was a fair sort of assumption? And I'm like, sounds low to me. So, and it's a little bit diverting from your question, but I think we have a dynamic now. Maybe it links into kind of other questions about reality of debt restructuring and whether things are sort of moving forward there. But I think there's still a lot of investors that are thinking, okay, well, the energy spigot's going to start growing, that this is going to happen, and so we're going to get paid at near par. That sounds either really optimistic or really pessimistic to me, in the sense of optimistic from a return, from a penny, sort of what they're getting paid, but pessimistic in the sense of, if they came anywhere close to that, I would be really worried about what investment is not happening in the country, and that then we would just sort of end up back in another unsustainable, burden. And there are other, each of these sanctions cases, just like each of the debt restructuring cases, is all a little different, but you sort of have some elements of the story that kind of ring across. And so I think this combination of sanction suspension, limitations on what the government is actually going to do, plus the sort of web of debt issues, I think I guess it's difficult to see, sort of how much growth there's really going to be. Plus, I think the Maduro government might also try to hedge and say, well, we're happy to have some more U.S. money coming in, but we don't really want to kick the Iranians and Russians and Chinese out quite so yet. So that, if part of the goal was dislodging this illicit trade, we'll see. There might be, I imagine when we start seeing the data, there'll be a little more oil going to the U.S., going to Europe, a little less going to China, because the Venezuelans can get more for it. You could tell I'm not super optimistic.
Well, isn't this also the sort of thing where if Biden didn't win in 24, or for some reason wasn't the president in 24, that this could completely change? I mean, Trump had his own sort of personal Bay of Pigs type thing when he dealt with Venezuela. So
Yes. No. That's very fair. And and I think congressional actors already are trying to think about how can they claw back even the measures that were done to date, and this is not a policy shift that is fully shared in the even in the Democratic Party. And so I think that is a real sort of risk, and another reason why company, it's one thing if you're Chevron and you stayed in, right, and sort of on the margins might increase, and this might make it a bit easier to operate, and maybe some of the oil services companies that support those projects come back in. But I think the risk of reversal, both for Venezuelan domestic politics reasons as well as U.S. ones, is quite high. And look, we're even seeing, another sanctioned jurisdiction, Iran. I think we are seeing a real shift, and pushback, understandably, but pushback in what had been a de facto, if not de jure, sanctions easing this year. Though the U.S. government wouldn't admit to sort of doing that, and and I think that maybe the net result that becomes a bit of a challenge is with these sanctioned jurisdictions and this growth in semi-illicit or illicit trade in the energy market. We've actually seen this development of gray and black fleet. We've seen, development of more energy trade transactions that are harder for the U.S. and its allies to kind of control and influence. And I think that's a net result not only of these sort of smaller sanctioned jurisdictions like Venezuela and Iran, but especially some of the dynamics going on with Russia.
Should that make us feel good or bad? Should that make us feel good in the sense that, trade is like osmosis and it will find the cracks no matter what sanctions and tariffs and whatever else you put on? Or should it make us feel bad that, not bad in the sense that, countries aren't doing what the United States wants, but bad in the sense that if there's not visibility into what's going on, I assume that means bad things from an energy security standpoint. Because if you don't actually know what flows are happening and where they're going and things like that, that seems like it would be very bad. So how should we read that?
Yeah, I think it's ultimately bad from a national security, sort of for a U.S. and broader security perspective. I mean, as you say, not just, I think that there are risks of, overreach and maybe this is an externality here. Because what I worry about is not only that one can't track energy security, but that you have coexisting illicit energy flows, use of dodgy payment channels, maybe sort of cross-pollination of other illicit activities, whether it's drug trade or so on, use of crypto mixers, different things like that, right? So I think these dark underbellies of the global economy, maybe they get bigger. The other thing I look at it and say is that this is a prime example of something we've seen happen also in other markets, which is that energy commodities are generally traveling longer distances. The tanker rates, they've come down a little bit, but tanker rates went up a lot because instead of energy coming through pipes, it was put on ships. I'm not saying that the right thing to do would have been Europe continuing to buy oil and gas from Russia, but it is a net result that some of the diesel that is consumed in Europe might go from Russia to India, get refined there, and come back to Europe. Which, we can also raise questions, but the net result, I think, for the consumer and even for businesses is that, unless you're in one of those intermediary channels, everyone's getting a cut of it before it comes to you. And so it adds to some of the inflationary pressure. There's some argument that a bit of that is happening and it's maybe a little less worrisome and nefarious. But that things like measures like the tariffs on China have led to Chinese and other entities operating, opening up factories in Southeast Asia or fill in the blank intermediary country. that's partly a function of COVID-related measures, rising labor costs in China. There's a lot of different things going on. But still, the net result is you're sort of having a remapping of global supply chains. And that's not a bad thing in and of itself, but it does mean that we need to be nuanced in how we, both assess supply chain vulnerabilities, but also in, understanding the real underlying, macro story going on, and the like. So I think ultimately having more of the trade of energy come via a sort of channels that are illicit or semi-illicit has a lot of negativity, not only from a foreign policy perspective, but even from a market perspective. I think a lot of it is a marketplace where I think people, if anything, see the risk and return characteristic and maybe are willing to take on more risk. There are a lot of political risks involved in some of the countries that are major producers. And so while it's good that there's some flexibility, I think sort of longer term, the fact that you have this segmentation of markets and that it correlates with more illicit financing channels, I worry about it.
You mentioned Iran, and I hadn't planned on asking you about Iran, but that seems like a good one to talk about in this context. And Iranian oil production seems to be up. I didn't notice that the Biden administration had changed much policy on Iran. It seemed to me like they wanted to, and they got left at the altar. But so what's going on with Iran? Why is production suddenly going up, and why is the U.S.? I mean, it seems to me they're looking the other way. You tell me if I'm right about that.
Yeah, I mean, and I do think this is an element where there's a bit of hypocrisy around the messaging that I don't think has served the administration. And again, I think the political dynamics of Iran's role in the economy has, there's a, things I might have said if we're having this conversation on October 6th versus, versus now. It is clear that the dynamics on the Hill and in a large swath of the U.S. political, space have really said, well, one of the things that we want to make sure to do, in their mind to support Israeli security, is to sort of crack down on Iran, make sure they don't have additional funds. I'd note that if anything, it's not clear that the Iranian proxies necessarily were doing things that were in Iran's own interest. If anything, Iran was probably pushing for some kind of freeing up space that would allow, a space where maybe Gulf countries would actually invest there on, energy projects and water projects and other things. But that's a different point. And I'll leave any foreign policy points to someone else. But, I think what happened over the course of this year and maybe starting towards the end of last year is that Iranian oil supplies started to sort of edge up, and then they kept edging up. And Iran was the biggest net contributor to sort of global oil markets. It contributed to, if anything, it meant that the kind of cuts that Saudi Arabia did to, in its view, balance the market were even greater. Because Iran is not subject to OPEC production targets due to sanctions, right? So that's caused some other frictions within OPEC, which we can get to. So any case, but throughout all of this, the Biden administration kept saying, "Oh, we're still implementing the sanctions, we're still doing this," and I'm like, well, either you're not implementing them as much, or you can't implement them. So one or the other has to be true. And my personal view is a bit of a combination, right? I think so if I step back, almost all of Iran's oil exports go to one buyer, which is China. And they go through a series of illicit channels through, some of it being stockpiled in Malaysia, some of it getting to China. This is sort of, as always, when there's only one buyer and it's illicit transactions. You can't really pay very well for it. Iran is a price taker here. Right. Now, obviously, if you increase the volume, maybe that's a better position to be in than they were a year ago, 2 years ago. But notably, throughout that increase in exports, you didn't really see a lot of other buyers, sort of showing up, in part because this was illicit trade still legally subject to sanctions. But in practice, clearly more oil was coming on the market, oil and oil products. And the like. So why I say maybe it's an inability or difficult thing is once a trade is illicit and goes almost underground, from a sanctions perspective, you have to keep targeting new entities and, almost escalating new targets to kind of stay in place, to maintain that sanctions pressure. And that's something that we saw, especially starting the middle part of this year, maybe late in the spring, the U.S. was no longer doing. And I think anecdotally, and timing-wise, I guess I should say, that coincided with when you had questions about the prisoner swap, the release of the dual nationals from Iran, this sort of release of funds that were Iran's money in that they were supposed to be able to use for humanitarian trade in South Korea. But the South Korean banks said, we don't want to touch that. We don't want to get secondary sanctions. So I think clearly whether they didn't, and that's where I think this messaging sort of becomes a damaging, dangerous thing, because a lot of market actors would say, well, clearly something has changed. You're letting these things through, clearly turning a blind eye. And so my view was that I think they looked at it as almost a corollary to what they were trying to do with Russia, which was to keep Russian oil on the market but pay them less. Now with Iran, it was add some supplies but keep paying them less. The discount, which coincided with, as I say, Saudi Arabia cutting. But I think it leaves them in a position where the domestic political costs of it are sort of, are high. And we've seen legislation pass the House, likely to pass the Senate on boosting enforcement of these sanctions. I have some implementation and enforcement, questions there, because I do think the people involved in this trade, they're not using U.S. bank accounts. They're not using G10 bank accounts. They're using, sort of the dark fleet. If there's challenges enforcing, the Russia price cap, there's even more here. Now, on the Russia price cap, I think also one of the challenges was at the same time, the U.S. was not really, and its allies were not really putting a lot of effort to enforcing that. And so I think it led to both issues at the same time, led to a view from parts of the oil market, those who are willing to take on greater risk, thinking that the U.S. only cared about having more oil on the market, and only cared about the gas price. And I think it makes it difficult to sort of claw it back. Now, I'm not saying that's, I think that there will be some reductions in Iranian supply. But, that I think it having created these channels leads to some other vulnerabilities ahead.
And maybe, sort of the last big topic that we'll tackle, because it just segues so well, and we can talk about OPEC in that context too, is just, where oil goes from here and where OPEC goes from here in the months ahead. It was a very unpopular view earlier this year to be bearish oil. I remember, because I got a lot of hate on Twitter for being bearish oil at the beginning of the year, and even I'm surprised at the fact that we're at November 21st here, we're recording, and we're at 77 for crude. We were touching lower 70s even last week. Even with OPEC continuing their cuts, and even with the Russia-Ukraine war still going on, even with a potential Middle East war with all the old players involved. So where do you think we go from here? Because you would have to think at some point the market is going to wake up and say, well, there's not enough supply. But we keep on seeming to blow through every single signpost where people said, well, this is the moment it's going to run back up.
Yeah. So I think part of the challenge, and of course we've had, we've had this kind of quite a volatile year, right? And I think, we started the year with, there was a lot of hope and optimism around how strong Chinese demand was going to be, right? And there was this view of the second half's going to be stronger because China is out of COVID lockdowns and they're just going to, have all of the oil. Now, if anything, that kept disappointing. It's stabilizing now. It's a little stronger. But if anything, I think it was more this story of GCC and then belatedly sort of Russia joining, this sort of cut story, this voluntary cut sort of element that partly I think reflects stories in Iranian supplies coming onto the market, actually, and some production from the Americas, including the U.S., which has surprised to the upside. Not so much shale anymore, but sort of Gulf of Mexico supplies and the like. And then I think there was a further, having already started to tighten, I think there was geopolitical risk, and that must mean tighter oil. And my view was maybe honed from a while tracking the energy markets and trying to avoid getting too drawn in on Middle East peace from a market perspective, because I often didn't see a market link there, right? I'd be very interested from a foreign policy, from a personal perspective. But what's the trigger that changes energy supplies? And so I think there was probably, and by the news of, maybe a little too much expectation that it would sort of bleed through. And then my view was, okay, well, if Iranian oil comes offline in a major way, or if Iran or Iran proxies knock GCC production off, like those are the game changers from that sort of war-related supply perspective. People talk about boycotts. Again, we'll see. I don't see a lot of appetite in OPEC to do that now, and I wonder how much the anniversary of the Yom Kippur War and the creation of OPEC and that cartel trend may be added to some perception in the market. But I worry now, that market actors often like to say, well, things stay flat from here, right? And I saw even some JP Morgan kind of commentary, the oil price will go down in 2025. and I haven't read their report in detail, so I probably shouldn't criticize it. But I mean, maybe they're baking in a U.S. recession or a Chinese recession. We'll see. Or OPEC cohesion falling apart. But I worry that the expectations now are sort of, okay, well, we've resettled at this kind of 80 range and we're going to stay there. And I think if anything, looking into next year, I think there's a market expectation that OPEC Plus kind of keeps its cuts. I probably agree with that. I'm not sure they're going to do a lot more. I think there's still a market perception that Fed cuts are going to come earlier than I think is likely. We'll see. I'm sure you're going to be talking about that on the podcast, and how that ties into the political sort of dynamics and the like. So I think that we're going to see probably, we could see some pretty wide, trading, sort of trading ranges, here. I see the GCC countries being pretty committed to their cuts. I think the shift towards somewhat more enforcement on Iran, reduce it, maybe brings a little bit of that off the market. Early in the year, right, we often have a little bit softer demand. So we could go a little bit lower than where we are. But I think once we get to the summer, I think we could see prices sort of, moving up again, unless we have sort of U.S. recession, Chinese further slowdown. We will see a U.S. growth slowdown next year versus what this year has been, and the like. I just worry that, that if anything, there's some sort of complacency in the market that we're now down to a level that, everybody can live with. When I think this has become a market that, if anything, is more driven by macro factors, including the sort of liquidity dynamics.
What you were talking about with sort of the dark fleets and the underbelly of the economy, do you feel like that's also impacting the price at all? Because I can't help but see that, you sort of look at oil prices from the start of the Russian price cap and things start to look unpredictable by any of the previous metrics or the previous models. And I like ever since then, I've been very triggered. Like I bragged about being bearish oil. We didn't put any money towards it, so I shouldn't brag about anything. Like I wasn't that confident about it. I mean, part of it was just because like things just haven't been working the way that I thought that they would be working in oil, as opposed to natural gas. There's been sort of a divergence there. Like natural gas is doing what I expect it to do, whereas oil is not. Do you have a similar level of confusion? Do you have any explanation for it, or do you think I'm missing something?
Yeah. And I think you're right. In some ways, a couple of things I think have happened in the oil market. One, like natural gas, perhaps it's become more of a regional market. It's become a little more of a regional market. At least in some ways. I'm not saying it's quite as much as natural gas. There is an increasing amount of energy volumes trading where we can't really trust what price they're trading at, right? There was a lot of points last year and this year of, were Urals prices actually indicative of what people were paying for Russian supplies. So you have a portion of the market where you can't quite tell what the price is. Some of that, arguably, that uncertainty was being captured by intermediaries, by shippers and tankers, and in these sort of longer journeys. Another thing I think that's complicating the market, and I haven't put all the pieces together, is that we've had this, if anything, I think the real tightness continues to be on the product side, on the refined side, which makes me think I need to invest more time in tracking it, or pay more attention to those who do have good infrastructure. But, we have this structural shift where developed economies are shuttering refineries, where, which, if anything, only adds to this energy travels long distances before it gets to the end consumer. New refinery capacity is being added in the Middle East, in Asia, maybe super slowly, eventually in Africa and Nigeria. But, sort of that element of the supply restrictions, I think, or the frictions, I think have become a more important sort of, part of that story. And so I think the net result that as oil prices ran up this summer and into the early fall, that the impact on kind of consumers was maybe greater than just what the sort of Brent, the Brent or WTI crude, trend to be. Plus, I think there's also can be a bit of a currency factor here, right? Oil prices rose a lot in U.S. dollar terms, even more in currencies that were weakening against the dollar. Some places like Europe and Turkey, they have pretty high taxes all the time, so the move maybe not as great. But the sort of net impact on consumers in parts of the emerging world and some of the Asian economies, was quite sort of sizable. So I think those are some of the factors I guess I'll be watching for. And then some of it also is just a relative, it's how much this tightening of financial conditions that we've seen across other parts of the trading market, how that's affecting the energy market. And I guess that's something we'll sort of be watching into next year.
Rachel, this was great. I could talk to you for like 5 more hours, but you've got to go and I've got to go and the listeners probably have to go too. So thanks so much for making the time, and we'll have you back on soon if you'll consent to it.
My pleasure.
Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.